Welcome, everyone. Thanks for joining the program. I'm your host, Ivy Han. There's a common perception among novice investors that investing is complicated by nature. They might feel they don't have the knowledge, skill, or effort needed to manage a portfolio, but it doesn't have to be that way. There are more hands off investing strategies to consider that can help investors reach their financial goals. And we're going to learn about one of them called the couch potato portfolio. Joining us is Dan Bortolotti, founder of the Canadian Couch Potato blog. He is also portfolio manager at PWL Capital and author of the book Reboot Your Portfolio: 9 Steps to Successful Investing with ETFs. So, Dan, thanks for making the time to chat with us today.
My pleasure. Thanks for having me.
So, Dan, you're a personal finance journalist by nature. Why did you decide to make that switch to portfolio management?
Yeah, that's right. So my training was as a journalist, and that was kind of my first career. I spent about 20 years as a writer and editor, and certainly not specializing in investing until the end of that of those years. Sort of around 2005, 2006, I started to be writing more and more about personal finance and investing. It was something that I became very interested in personally, and when I created the Canadian Couch Potato blog in early 2010, I started to, gain a little bit of an audience. There was an appetite for this kind of strategy. People were looking for ways to invest more easily at lower cost with a bit more hands-off approach. And as it started to get popular, I started to realize it was something that I really enjoyed. I enjoyed sharing my passion for it. And a few years later, I was invited to join PWL Capital and go from just kind of writing about investing and giving people kind of generalized advice to actually working directly with clients. And so I've been doing that now for close to 10 years.
hmm And Dan, I know that you're a big believer in the couch potato strategy, but it was actually another investor who actually invented it. So here goes my trivia question for our audience. So the trivia question is, who invented the couch potato investing strategy? So stay tuned until the end of our conversation, and we'll reveal the answer then. So Dan, let's get into our discussion for today. Now, I know you talked a little bit about this. Let's lay some groundwork for our audience before we actually get into the details of the couch potato strategy. The couch potato strategy is a form of so called passive investing. What is passive investing and what are some of its potential benefits?
Okay, so I guess, to help understand what passive investing is, it's probably helpful to understand its opposite, which is what we would call active investing or active investment management. Um, Active investment management is primarily designed to what we would say beat the market. So, in a given period, if the market's return was 7 or 8%, let's say it's 8%, your goal as an active investor would be to pick individual stocks or time the purchases of those stocks in order to achieve a return that is higher than that market average. With passive investing, the focus is different. It's recognizing that market returns over the long term are very good, and or at least have been in the past, and we hope they will be in the future, and that most investors can be very successful in their financial lives simply by capturing the returns of the overall market. It's not necessary to beat the market. If you would just simply owned an index fund that tracked the Canadian, US, and international markets over the last 40 years, you would have done exceptionally well. You would have been able to grow your wealth at a rate that far exceeded inflation, and you would have achieved any realistic financial goal. So the opportunity is there. It doesn't take any particular skill. It just takes a little bit of knowledge about how to set up the portfolio at the beginning, and it takes the discipline to maintain it over time. And then I think really the thing that we haven't talked about yet is one of the greatest appeals of passive investing is its extremely low cost. So these index funds that I'm talking about, or ETFs, which is a different type of product with the same kind of strategy. These are funds that can be purchased for as low as 0.05%. The fees can be that low. You can easily build a very diversified index portfolio for no more than 0.25%. And just for reference, that would be $25 a year for every $10,000 you have invested. So extremely low cost for small portfolios, and even for larger ones, that is a fraction of the cost that a lot of people are paying for more active strategies.
Great. And I guess, when it comes to investing strategy, we always wanted to consider the potential downsides. So, what are some of the potential downsides of passive investing for investors to consider?
Yeah, so I think, I mean, there are definitely downsides to all investing strategies, but in this case, I would say that the downsides are really more behavioral. So the first thing is, I think you need to understand that you will never beat the market with this type of strategy. Now that sounds like you resigning yourself to defeat, and that turns a lot of people off. And if you feel like that, then it's probably not the right strategy for you. I would counter that, of course, by saying the vast majority of active strategies don't beat the market either. But what they do is offer at least the possibility that that could happen, and almost certainly will happen over many shorter periods. Whether that outperformance persists over periods of 5, 10, 15, 20 years is a different story. So you do have to be content with the fact that you are going to get the returns of the market, no more, no less. I think the other challenge, and certainly I've seen this with clients and with readers of my blog, is it's very boring. And some people, frankly, consider investing to be kind of a hobby. They love reading financial news. They love getting their hands dirty, rolling up their sleeves and getting into their portfolio and doing all kinds of trades because it's entertaining and fun. This is the opposite of that. You need to embrace the boredom of passive investing if you're going to be successful at it. You have to just accept, I'm going to set up the portfolio in the right way. And then year to year, all I'm doing is adding money, right? I'm just adding regular savings, but I am not tinkering with it.
hmm And you have talked a little bit about this already, but one of the interesting points you made in your book is that you feel it isn't worthwhile for most investors to try to attempt to outperform the broader market, and that aiming to earn average return is generally speaking enough. So, do you have any data that you feel would potentially back up your position?
Well, I mean, and there is a lot of data about this. So if you look at, say, rolling 30-year periods, which means you can basically take any period of consecutive 30 years, over the last century or so, probably would have earned a return in the market somewhere in the neighborhood of 7 to 10%, again, depending on which specific market you're looking at. And so, that's probably like a long-term return on stocks has typically been around 5% above inflation, right? So if we can accept that, basically anybody who is saving for retirement over, a lifetime or a career, if you earn a return of 5% over inflation over the very long term, you are likely to achieve any financial goal, any realistic financial goal that you set. Are you going to become fabulously wealthy while only saving 3% of your salary? No. But if you are, if you have a realistic savings plan, and all you want to do is grow your investment at a rate that exceeds inflation, relatively consistently over time, then you don't need to beat the market, right? And I always remind people too that if you needed to beat the market to have a successful retirement, there would be a lot fewer successful retirees than there are, because very few investors have a lifetime record of market beating returns. Most people don't do that and still can retire comfortably. If you are able to achieve a return over your investing career that is very close to the market average, you will be an exceptional investor. You will not be a mediocre one. You may be in the top 5, 10% of all investors, because it's that difficult to do.
So let's start unpacking the couch potato strategy. So, how would you describe how it works to someone who is totally new to investing?
The basic idea is that you start with a group of index funds. Again, an index fund being one that simply tracks the overall market. So if you're trying to get exposure to Canadian stocks, instead of picking 3 or 4 of your favorite dividend paying stocks, basically buy the entire Canadian market. And you can do that very easily with an index fund. So the portfolio itself is assembled from a number of index funds. And these are going to be a mix of stocks and bonds, and further subdivided that the stocks are going to include typically Canadian stocks, US stocks, and international stocks. So if we look at it from that perspective, you can probably put together your portfolio with no more than about 5 or 6 funds, one for bonds, one for Canadian stocks, one for US stocks, and then probably 2 for international stocks, because most of the funds are divided either developed markets, so typically Western Europe, Japan, Australia, and emerging markets, which would be things like China, Taiwan, South Africa, Brazil, etc. So a little bit more risky, but just by holding those 4 or 5 funds, you essentially are giving yourself exposure to the entire global stock market. And by investing in literally thousands of individual businesses, you are about as well diversified as you can get. So the next part of that is to choose a target for each of those funds. And when I say that, what I mean is the mix of stocks and bonds in your portfolio is going to control the amount of risk that you're taking. More stocks means more risk with the potential of higher long-term returns. And typically more bonds will mean less risk, but also accepting slightly less in expected return over time. So every investor needs to determine what mix is right for them. If you're a young investor with a long time horizon and it doesn't bother you to see markets going up and down 20 to 30%, you could go even 100% stocks, but typically more like 80 or 90. If you're a retiree and you don't want any market volatility to keep you awake at night, you're going to have to go with a much more conservative portfolio, perhaps 20, 30, 40% stocks. Many other investors are going to fall somewhere in the middle. Once you've found an appropriate mix for your portfolio, then your goal is really just to try to stay on that target. So let's use a simple example. If you had a balanced portfolio of 50% stocks, 50% bonds, over time, that portfolio is going to move off its target. It might get up to 55 or 60% stocks after stocks have performed really well. And your goal then is to just simply sell some of the stocks and buy more bonds to get back to your 50-50 target. Mm-hmm. And by staying focused on those basic things, broad diversification and discipline, that is the extent of the decision making, that you're doing day to day. You're always going to have some exposure to the winners and to the losers. And just by trying to stay on those targets over the long term, that's the extent of the decision making. It involves no forecasting at all. It just involves discipline.
Mm-hmm. And the couch potato strategy, generally speaking, aims to use as few investment funds as you mentioned. Sometimes just one fund might actually do the work. And are there potentially any other, you might call it, benefits of keeping the number of funds relatively low?
Yes, definitely. So one of the pillars of the couch potato strategy, it's not just about low cost and broad diversification and discipline. It's all of those things. But the idea, this is where the nickname couch potato comes from, is it's supposed to be pretty low maintenance, right? And one of the things that I have found through experience, what defeats a lot of do-it-yourself investors, is trying to maintain a diversified portfolio with many holdings across multiple accounts. So if all you have is your TFSA or your RSP and all of your funds are held in that single account, then you can probably get away with a few more funds. It's not that difficult to manage. But, there's a lot of families, let's say you're a couple and you both have an RSP and you both have a TFSA. Oh, and you also have a locked in retirement account from a pension that you used to have at your former workplace. And now you've just opened up a new taxable account. Now all of a sudden your household has 6 or 7 different accounts. Well, now it comes time to rebalance that portfolio or you're trying to maintain it. It can be very challenging. So the good news is that there are now, in the last few years, ETF portfolios that are called asset allocation ETFs. And these are essentially one stop shopping. They're one ETF that holds multiple ETFs. And they have a target mix. So you find one that's appropriate for you. If you're aggressive, you might pick one that's 80% stocks. If you're more conservative, you could pick one that's, say, 40% stocks. And the portfolio manager builds it for you and they manage it for you. So they keep it in balance. It's always going to be very close to that target. And if you can embrace that kind of simplicity, you can literally purchase that same ETF in each of your accounts. And then it's almost no maintenance at all. All you need to do is add money from time to time. And whenever you add money, you've only got one fund to buy. So there's really not much decision to be made. If you want to get away from that kind of one fund solution and build a little bit more customized portfolio, you can definitely do that. It will reduce your management fees and things a little bit. But even in that scenario, I would say you rarely need more than four, maybe five or six funds to get as broad of diversification and optimization as you need.
And you sort of talked about this already, but let's maybe elaborate on your fund selection criteria. So, what are some major factors you consider when choosing funds for your couch potato portfolio?
Yeah, so remember, if we go back to the fundamental idea that the point of passive investing or couch potato investing is to capture the returns of the overall market. So if that is the case, then it makes sense for us to look for index funds and ETFs that track the broad market and not
Mm.
some narrower subset of the market. So let's use Canadian stocks as an example. So if my goal is to capture the returns of the Canadian stock market, then I'm clearly not going to purchase an ETF that only holds Canadian utility stocks or only holds dividend paying stocks. There's nothing wrong with dividend paying stocks, but there are a lot of companies out there that don't pay dividends and they could be perfectly good investments. And so, if you're going to if you're going to purchase an ETF that tracks only certain types of stocks in the market, you're not getting broad exposure. So instead, it makes sense to look for an ETF that holds as many Canadian stocks as possible and sets as few rules. Really, your second comparison point needs to be cost. So if you see two funds that have very similar strategies, they track very similar indexes, but one of them is, 0.15% and the other one is 0.10%, all other things being equal, take the cheaper one.
Mhm.
Over time, usually that lower cost is going to result in a little bit more return for you. Right. And then I think the third thing to at least consider is the fund's track record. So I don't want to suggest that, new funds, no one should ever invest in a new fund and needs to have 20 years of performance before, you can invest in it. But I think it's fair to say that if you are looking at different funds, again, very similar in their strategy, very similar in their cost, but one of them has been around for a long time and has a lot of trading volume, which means there's a lot of investors out there buying and selling it every day, you may just find that it's a little bit easier to transact. So if you stick to kind of the larger, more well-established funds that are also meet your other two criteria, you may very well be better off that way.
Mm. Now, I wanted to take a brief moment and to show our audience how they can compare funds for the considerations you mentioned. So let's quickly hop into WebBroker for a closer look. Click on Research, and under the Tools tab, click on Screeners. The Screeners tool allows you to filter investments by specific criteria. You're able to filter for stocks, technical events, investment funds such as mutual funds, and ETFs. And as an example, under the ETFs tab, you're able to look at feature screens as well as creating a new screen by clicking on the Create Custom Screen tab. And this will bring you to a page with a variety of criteria that you're able to use to filter out the funds. And for today, we will look at 3 criteria as considerations when screening for investment funds. And please note that depending on your investor profile and risk tolerance, there could be other criteria which can be more suitable. And the first criteria we're going to look for is diversification of a fund. Although there's not a specific criteria called diversification, however, under overview, you can potentially add diversification to your portfolio by choosing to add different categories of fund under fund category, fund types, or simply adding in index as your criteria. And in this case, we're going to add index as our first criteria. And the second criteria we're going to look for is expenses, also known as management expense ratio. And note that when screening for investment funds, again, it's going to be under the Overview tab. And we're going to click to add management expense ratio onto our screen. And lastly, we're going to look for funds with some sort of track record. And to screen for this, we're going to go under Portfolio and then add in both fund inception as well as total net assets. And once all of the criteria are added, you can then scroll down and adjust accordingly. For example, we can choose to include funds from both Canada and the US. We perhaps only want to look at index funds. We may also want to look at funds with lowest and below average MERs. We may also want funds that have been around for more than 10 years with a total net assets of more than 2 billion. And note that as we make our selections and over on the right, the results will narrow and you will be able to look at a consolidated results combining all of the criteria. And also know that you can exclude mutual funds from your results by simply uncheck and click on View Matches again. And in this instance, we're just going to keep the box unchecked and we're only going to be looking at ETFs. And on this page, you're going to see different types of ETF and mutual fund information available, such as summary, profile. You can see ratings information on a risk-adjusted basis provided by Morningstar. You can see performance information for different time frames. You can see additional risk information and holdings allocation information. You can also pick up to 5 funds to compare side by side. And in this case, we're going to pick the first 5 and click on Compare. And this will bring you to a page where it's going to show you all of the funds that you had clicked on and picked on this page. And once you have it on this page, you can see that we have the additional information available from the previous page, such as summary, profile, ratings, performance, holdings, allocation, etc. And if you want some additional information about the ETF or mutual fund, you can click on the symbol of that fund or the name of that fund. And a box like this will pop up and you would want to click on summary. And this will bring you to a page that will give you additional information about this fund. And in this case, you'll find detailed information on how to trade this mutual fund or ETF, some additional sector and geographic region breakdown. You can see asset allocation information and top 10 companies that this ETF or mutual fund is holding, and Morningstar ratings on a risk adjusted basis, as well as some additional fundamental information towards the bottom. All right. Hopefully, that demo gives our viewers one way to get started with their screening process for funds that might fit their investing priorities. And keeping track of your couch potato portfolio or strategy, I'm sure that it isn't entirely without effort. So, what sort of portfolio maintenance do you perform to stay on track with your investing goals?
Yeah, exactly. I always say, a portfolio, it's like a garden. There's low maintenance gardens, but there's no maintenance gardens. You always have to do a little bit of work, and so the same is true with a passive portfolio or a couch potato portfolio. And really, the main thing that you're going to need to do, and again, this is if you're not using one of the asset allocation ETFs we've talked about, is you are going to need to rebalance from time to time. So the question we often get is, well, how often do we do that? Am I doing that like every week? And it's like, no, way too often. You don't need to do it every week. You don't need to do it every month. In fact, in most cases, except when markets are really, really volatile, even once a year is fine. And there's been a lot of research on this too, like whether you can enhance your return a little bit by rebalancing more frequently. And the overall result of that research is not reliably, right? Like it doesn't make that much of a difference what your frequency of rebalancing is like, as long as you do it at relatively consistent intervals over time.
You mentioned some of the common mistakes. Can you maybe share a little bit more about other mistakes that you have seen investors make with this strategy?
Um, Being cost conscious is extremely important. I've been advocating for that for many years. But it is possible to go too far down that road and focus only on the management fees of your products as if there were no other considerations at all in investing. And so, what you sometimes have is people choosing multiple funds because each individual one is cheaper than one of the easier solutions that we've talked about. Like, for example, the asset allocation ETFs that we've talked about offer a really convenient one fund solution, but they are a little bit more expensive than if you had built that kind of portfolio with each of the underlying individual funds. And so people will say things like, well, why would I pay, 0.1% more for the convenience of, this one fund portfolio? I can buy all the individual parts and the MER is a lot lower.
Mhm.
And that makes sense in theory. And there's nothing wrong with that if you think you can manage that more complex portfolio. But it ends up being self defeating in many ways because you are choosing a group of funds that have a lower overall fee, but maybe now you're making more transactions. You're not rebalancing because it's too difficult or time consuming. You're making mistakes. And all of these things end up costing you more than the small extra fee of the easier solution. I would say that the other big mistake with this strategy that we see all the time is tinkering. And by that, I mean they start adding layers and layers onto the portfolio because they think it's more sophisticated. They think it's more diversified. And really, all it is more complex and in some cases more expensive. And so, accept the fact that I know it's only a small number of funds. It might even be only one fund, but just because it's simple, it doesn't mean it's simplistic. And these portfolios are really well designed. You're probably not going to improve on it by tinkering. And in fact, you're more likely to just break something.
Now, some investors might like the idea of blending a passive couch potato portfolio with more active strategies, such as actively stock picking, for example. What's your take on that approach?
Almost everybody, in my experience, uh, does a little bit of active investing on the side. And so I get it. I respect that. I also think there's no harm at all in it if you do it with a limited amount of your portfolio. The only thing that I would say about that kind of strategy that I have seen firsthand can be harmful is, let's say that you do have 90-95% of your portfolio in a passive index ETF strategy and you buy a few stocks on the side. Well, which part of the portfolio do you think you're going to focus more of your time and energy on? Because I'm pretty sure it's going to be the stocks. And so now you're reading the business news and you're following the ups and downs of individual companies, and you are just distracted. Stock picking, there's a lot of luck involved, and it's like, I can go to the casino and play blackjack for an hour and do really well. It isn't because I'm a genius blackjack player, it's just because I got lucky. And you can see the same kind of thing with stock picking. You go, you pick a few stocks, you have some initial success, and now you think, hey, I'm really good at this, right? And in fact, I'm so good. Why am I wasting my time with these boring index funds when I can just pick stocks? And I've seen that happen. I've seen people have a little bit of initial success, abandon a passive strategy, and then, your stock picking strategy works until your luck runs out. So, again, I'm not dogmatic about this. I think people can do a little bit of anything they want on the side. Just try to remember that it's for fun. Don't make it a big distraction, and make sure that you don't neglect your serious money when you're having fun with the speculative stuff on the side.
Awesome. All right, Dan, we're going to have to leave our conversation there. Thanks so much for giving us a tour of the couch potato strategy. That was extremely insightful. And hopefully, our viewers now feel a little bit less intimidated by the process of investing if they're hoping to get into a more passive approach. Now, before we wrap things up, let's not forget about our trivia question. So, as a refresher, the trivia question was, who invented the couch potato investing strategy? And the answer is newspaper columnist Scott Burns invented the couch potato strategy back in 1991. He was inspired by a growing body of research suggesting active managed funds underperform the broader market over the long term. Burns pitched the strategy as a way for everyday people to potentially earn a return in the top half of professional investors with virtually no effort or thought. So, before we actually wrap things up, Dan, have you actually met Scott Burns in real life?
Yeah, I never met him personally, but we definitely had a conversation on the phone because I did want to talk to him about the fact that I stole the term couch potato for my own blog. He's a really interesting guy, and what I found most interesting about him was his career path was very similar to mine in that he was a journalist for many years, an investment writer for the Dallas Morning News. And when he created this strategy, slowly it became more and more popular. Remember, this was 1991. He was way ahead of his time. This strategy was not widely followed at all at that time. And he eventually made a transition and became an investment advisor himself, just as I did. And we had very similar experiences and stories. So it was a fun conversation to have with him.
That's awesome. So, thanks again for your insight, Dan. We really appreciate you making the time for us. And for those in our audience, make sure to register for our upcoming live events and check out our library of on demand content available in the Learning Center as well as our YouTube page. See you all next time.